Personal finance questions. Harshvardhan Roongta of Roongta Securities joins us. Our first caller is from Chennai. Mr. R.N. Srinivasan is calling. Go ahead, Mr. Srinivasan.
Yeah, I have a surplus of 25 lakhs and I would like to invest in some mutual funds. Besides all those things, I have sufficient amount of insurance and all those kind of things. I have one daughter whom I want to educate in the best of the institutions. So what do I do with that kind of money?
So you want to invest this 40 lakhs with the intention of probably providing for education?
Not only education. I think she's old enough now. She's around 17. So going around, she will be another 10 years down the line, 27.
Okay.
So give me that kind of a range where I can, what do you call in the marriage and all those kind of things.
So for 10 years you don't want to touch it, or for 8 years later you want that? What is the time period of investment?
10 to 15 years. I don't mind it.
Okay.
And one more thing. Kindly understand. Like others, I am not like that. I will take high risk and I want high returns.
Okay. Fine.
That is, if you don't take risk in your life, you will not get any.
Fair point. Okay. Over to the expert. Go ahead, Harsh.
Well, Lata, if I've understood correctly, he wishes to invest 40 lakh of rupees for a period of 10 to 15 years. And, the purpose is that he needs to accumulate wealth over a period of time, and he understands the relationship between high risk and high reward. So is that what I've understood correctly?
Yes. Yes. There's also a little bit about insurance background. His sum assured is 10 lakhs and he pays a premium of 30 years, 30,000 yearly. It's an insurance scheme from Tata EIG.
Okay, fair enough. Now, well, Mr. Srinivas, I would want to advise you, because I am happy that you understand the risk, the difference between you understand that you need to take risk to get high rewards. So I'm offering you a suggestion which is in the form of a two-step process. You could park this entire 40 lakhs into a liquid scheme, a liquid fund offered by a mutual fund, say for example an HDFC cash management fund, Treasury Advantage plan. So this invests entirely into debt. So at this moment when your money is getting invested, is going 100% into debt. Now from here, the second step is that you give an instruction to HDFC mutual fund, tell them to transfer daily, every day, tell them to transfer 9,000 rupees into an equity scheme of the same fund house. So you could choose an HDFC equity fund and transfer every day 9,000 rupees into equity. Now in this form, over a period of 2 years, your entire 40 lakhs will get invested into shares, into equities. Now in this period, I'm assuming and hoping that the markets will be more stable by the end of 2 years from now. So in the volatile period, you entered into equities. Now from the second year, say to 1 year before the date on which you require the money. So say if it's 10 years from now that you need the money, from 2nd to 9 years, you remain invested into equities. Just evaluate the performance of the fund. If you're not happy, you can switch it into another well-performing fund. But remain into equities from 2nd year to the 9th year. And after the 9th year, when your target is just about your goal or your expenses 1 year away, you start withdrawing money out of equity and parking into areas which are not volatile in nature, so that you're protecting the gains that you've made over the period of 9 years. So in this case, you would be able to capture the the benefits of equity markets, and at the same time enter in a piecemeal method and try and capture and benefit out of the volatility in the next 2 years from now.
Harsh, just one question. Should all the 40 lakhs be invested in only one type of an HDFC equity fund, or does it make sense that in HDFC as well you could recommend 2 or 3 funds to break up his equity portfolio?
Well, that's a very valid question, but but if I look at the HDFC equity fund by itself, it's a multi-cap fund. We're not concentrating on any particular segment or any particular capitalization. So fund manager has the liberty to actually invest across the industry. It's more of a diversified kind of a portfolio. Secondly, each fund in itself also has a number of stocks. So if I'm saying if they have about 50 companies they're investing into, that's well enough a diversification. So for the sake of convenience, and it's anyways an STP, so every day the money is going to get transferred. There are a lot of transactions are going to happen at the end of 1 year. If you look at the statement, there will be 240 transactions because it's 20 working days a month. So there will be 240 transactions in one statement, and then multiply by 2 or 3 schemes, it just becomes too much of paperwork.
All right. Do we have another SMS? We need to. Okay, we need to slip into a very short break on that note. Harsh, thanks so much for joining us.